It's earnings season and the financials have been having a pretty rough quarter, but Morgan Stanley's had kind of the worst among them. What's going on over there?
You know, it was a tough quarter in general for the financial industry, largely because of rocky markets, the European situation, the slower U.S. economy, slowdown in China. None of that good for the financial industry. And Morgan Stanley today came out and they missed estimates. The rest of the firms, Goldman Sachs, Bank of America, Wells Fargo, JP Morgan, Citigroup, they all cleared a very low earnings bar. Morgan Stanley did not. Their trading business was really the culprit. Conditions were just not good for them in general with trading. And then the Moody's downgrade, which came in June, it was only 2 notches, could have been 3. But a lot of clients certainly played the wait-and-see game and may have cut back on their dealings with Morgan Stanley, may have gone to other firms to do some of their business with while they waited for that downgrade. That seemed to be the biggest impact. Next couple of quarters, we'll have to watch and see if Morgan Stanley actually lost share or if their clients just sort of sat on their hands for a quarter, which we'll see. I
guess we've got some layoffs coming in the financial sector.
That's been the theme for a few years now. It's an industry that is shrinking in terms of personnel. The biggest firms still control the lion's share of business in the industry and assets, but it's unquestioned that in this market, especially with the Fed sitting on very low interest rates, when it's harder to make money in the traditional lending business, you can't afford to keep expenses at very high rates. When earnings come down and earnings are weaker, you have to bring expenses in line, and that's why you're seeing all these layoffs.
So Fed Chairman Bernanke recently spoke to Congress. Can we expect QE3 to finally arrive soon, and will that help the market?
If I had to sum up Bernanke's 2 days of testimony this week, the way I would describe it is that he's continuing to buy time. He's not committing that he's going to come in with more QE3, but he's certainly dropping plenty of hints that the Fed is ready to act if the economy continues to worsen. The employment statistics have not gotten better. They've averaged 75,000 non-farm payroll jobs a month for the second quarter. That's much weaker than the first quarter when we were well over 100,000. If that trend continues, and the Fed will meet on July 31st and August 1st, and then again in September, you could see some action out of one of those 2 meetings. I wouldn't bet on it coming out of this next meeting at the end of July. I think it's still too soon since the Fed extended Operation Twist through the end of the year, which it did in June. I think the September meeting, if things are worse, that's where you might get some indication of it. The one thing I would watch is Jackson Hole, which is the annual Fed symposium that they have out in Wyoming, and Bernanke gives a keynote address there, and in years past, he's used that as a means to communicate to the market what he plans on doing in the fall. In the past, we've seen QE1 come out of that, we've seen QE2 come out of that. Certainly something to watch in August.